Good afternoon and a warm welcome to the Colliers webinar. We have a packed agenda today, but I'm delighted that we've got a really good panel, and we also have Jessica Middleton-Pugh from React News moderating. The agenda for the presentation on the market update consists of the occupational market, the investment market, sustainability, and then we're moving on to the panel discussion. I will now hand you over to Jessica to introduce the panelists.
Thank you very much, Len. So I'm Jessica Middleton-Pugh. I'm a residential and retail correspondent at React News. So Colliers has been very kind in helping me keep my hand in on one of my favourite sectors, aside from those, the industrial and logistics market, which, to be fair, alongside beds, has rode out the pandemic rather well. And so, as Len said, now we are hopefully moving away from the challenges of the last year. People's minds are going back to that major issue, which was grabbing headlines long before COVID did, and that's climate change, the conversation around decarbonisation, and the green innovations that are hopefully going to come with it. So carrying that conversation on, we have great presentations now, and then a panel discussion where we will be joined by Bruce Topley, Managing Director of the UK business at GLP, Kevin Say, Vice President for Corporate Real Estate for UK and Ireland at DHL, and Andrea Guzman, Head of Sustainability at Colliers. But before we move on to that panel discussion, let me hand back to Len and also Andrea Ferranti, Head of Industrial and Logistics Research, for our opening presentation. Thank you, guys.
Many thanks, everyone. And thanks for the introduction, Jessica. Let's kick things off with the latest take-up activity for units equal or greater than 100,000 square foot. So demand for the industrial and logistics sector remained really bullish for the first 3 months of the year, posting a healthy take-up of 8.6 million square foot. This actually followed a record level of annual activity, which saw take-up reach 49 million square foot in 2020. But if we look at quarterly trends, and Q1 2021 is actually relatively in line with the 5-year annual average of 8.7 million square foot, which is quite astonishing, considering the record numbers seen in 2020. Meanwhile, in line with the recent market trends, there continues to be strong occupier desire for Grade A space. This is fueled by several factors, such as the lack of availability, occupiers seeking efficiency savings, while in some instances, of course, pursuing the green agenda, the growth of the e-commerce, which is turbocharging demand for fit-for-purpose facility, and the provision of new stock as developers are increasingly confident with this buoyant market. But if we look at actually take-up by size, which I think might give us a better barometer of current market activity, and here you're seeing deal count activity across different size bands since 2018. It is clearly noticeable that all size bands have recorded strong occupational demand, with the larger end of the market also breaking new records in 2020. This is a clear testament to the strength of the market, in my view. In Q1 in particular, the size band 100,000 to 199,000 square foot got off to a really strong start, with 32 units being taken on take-up for the quarter. But on this note, Len, I'd like to get your opinion, if I may.
Thank you, Andrea. Of course, what Andrea said, e-commerce continues to drive the logistics market, and Amazon are as active as ever. Out of those transactions taken place so far, Amazon account for 1.7 million square feet of the take-up, which as a percentage equates to just over 20%. It's pleasing to see that other occupiers are coming forward. Buy It Now have taken space in the Midlands. And what's really, I think, also good news is how active the 3PLs are. You know, Siva and Wincanton, both of them are taking in excess of 500,000 square feet this year already, which I think is really positive for the market. Back to you, Andrea.
Thank you. Thank you very much, Len. But On the supply side, if we actually move on to the next slide, so the market has less than 30 million square foot of available space, and this also includes speculatively developed units, which are actually scheduled for completion by the end of June this year. This equates to 5.3 vacancy rate, which is the lowest that we've seen in actually over the past 5 years. But when looking at the actual number of units available across the different size band, the first things to notice is the significant contraction seen within the 100,000 to 200,000 square foot size band, which actually now we move on from Q1 2017, where we had nearly 130,000 units, to the lowest that we've seen since then. To analyze this in more details, one should be mindful that the larger end of the market typically sees more design and build happening, and one of the reasons is actually the lack of available units. The market is really tight at the moment, Len. However, there are numerous spec projects under construction, and can you share again your view on this one?
Thanks, Andrea. I think the first thing to say is obviously on the previous slide, at the larger end, it did look slightly quieter, but we believe that will pick up. There's a number of units which are currently under offer, which will help these stats at the larger end. I think the other important thing is the amount of spec which is going to be constructed in 2021. From a Colliers research perspective, we believe it's going to be around 11 million square feet for 2021. What's really positive about that so far is 2.5 million square feet assigned, which obviously takes availability down to circa 8.5 million. This shows a really positive trend going forward for the sort of 100 to 200 as well as a larger end. Back to you, Andrea.
Thank you very much, Len. Let's now take a look at how this is affecting rental growth. So we should be considering that the industrial sector is the only sector alongside large-scale residential that has seen rental growth during the pandemic, particularly over the 12 months period to the end of 2020. But when analyzing historical figures from the MSCI sample, you can clearly see that there has been a rental growth occurring across the board in London, South East, rest of the UK, across standard industrial units and distribution warehouses nationally. However, as highlighted for the 2020's observation, so the lockdown restriction have had an effect on the speed of overall rental growth, in my view, particularly for secondary locations, I believe. And this has been dragging down growth rates as reported by the MSCI in their sample. But let's now take a look at the forecast, our forecasting model. So what are we expecting over the next few years? Based on our modeling, which looks at the MSCI sample as well, we continue to see good level of rental growth, which will further drive investment activity for the foreseeable future, we believe. Assets located in London and the South East are set to benefit the most. However, if you look at the prime end of the market, of course, London and the South East will do extremely well and in our view continue to outperform. Some of the regions have seen great level of rental growth, particularly in the Northwest, Yorkshire, and we're seeing some good level of rental growth coming through in the Midlands as well. So this is going to be very challenging for occupiers, Len. Can you share your view on any recent transaction or lease negotiation that you had?
Yes, we're lucky enough to advise some key occupiers, and a number of these requirements for various reasons, COVID, internal sort of strategy reasons, sort of come forward and go on hold. We had a number which we're working with before Christmas, where we requested terms from the developer and the funds on various proposals, which was great. It came forward. Sadly, we had to sort of stop negotiations for internal reasons with our occupier clients. And then we started to renegotiate again, sort of more recently. And there's two things which have happened. One, the unit has gone, which happened on one or two of the ones we're involved in. And then on the ones which hadn't gone, we've seen that the developer and fund have said to us, well, then, you know, you were looking at this a while back. Sadly, you know, there has been some rental growth. And in some cases, the rents had actually gone up to what we're being offered now, to what we're offered prior to Christmas. So I think it is a real struggle for the occupiers at the moment. That said, I'll talk about some things which are helping, which maybe some of the funds and developers can aid the occupiers on when we come on to our yields, Andrea.
Thank you very much, Len. So let's now take a look actually at the investment landscape here. So investor appetite remains really strong with a wide range of buyers chasing, unfortunately, limited amount of opportunities for multi-let and single-let industrial assets. With regards to actual investment volume, so Q1 2021 topped 3.4 billion, which is actually the largest Q1 on record. And this followed the extraordinary Q4 2020 of 5.6 billion. Again, so this is extraordinary. And if you actually add them all up, over the past 6 months, we saw more than nearly 9 billion pounds being invested into the sector across multi-let and single-let industrial assets, which is actually higher than the 8.7 billion, which is the 5-year annual average for the full year. But so what is driving this? We're actually seeing further yield compression coming through in 2021, and this is going to be driven by a combination of factors, such as, of course, the supply-demand imbalance, the low financing rate and treasury yields. So the yield gap makes industrial investment highly attractive to pension funds and other type of funds and investors, whether it's national or international investors. Then you have a strong rental growth coming through, and future expected rental growth looks still really healthy across the board, particularly for prime units. And then, of course, the growth of e-commerce. So this actually brings us to the next slide, where we are going to be looking at yields, net initial yields, as reported by the MSCI. I should mention before we go through this table quickly that this is, of course, looks at institutional stock, so grade A, grade B in prime and secondary location, not only in prime location. So here, what I've included, I include the net initial yields across these segments from March 19 to March 2021. And at the bottom of the slide, you can see the change in basis points. So we've gone between -4 to nearly -50 basis points across the industrial sector. And then again, Len, I would like to ask you your view on this, because it seems that yields don't really have that's keep compressing.
Yes, Andrea. I think the first thing to say is for a prime product where you've got it in a great location with a good building and an excellent tenant on a long lease, I think there's going to be still massive pressure on this type of product. And one of the reasons is very little of it is coming to the market. We're involved in a number of key occupier deals for in excess of 700,000 square feet across the country, where I wasn't involved in investment sale, but when the investments did go to the market, they went for anything from between 25 to 50 basis points, and in one of the cases, 100 basis points below what the quoting terms for the investments were. I think the other benefit maybe for some of the occupiers on this is maybe developers and funds can look at offering a slightly shorter lease term because the yields are so attractive. Maybe on something in a prime location with good covenant, for something on a 5 or a 7-year term, the argument could be had there's not a massive difference between a 5 or 6-year lease to a 10-year lease, which may be more helpful to the occupiers. I'm not advocating everyone should do it, but there is that potential option out there in the market. Andrea, back to you.
Thank you very much, Len. So this actually leads us to our last 2 slides of this presentation, where we're going to start talking about sustainability here. So briefly, because I don't want to steal any airtime to our fantastic panel discussion, just going to go through this. So we come up with this infographic, a little bit of metrics, just how our industry can boost sustainability. So there's been a lot of talks around how can we measure this, and et cetera, whether or not it's going to have an impact on capital values, rents, and yields. So the first thing to address here is the measurability. Then, of course, regulation is going to come in and will be tightened, and also the minimum requirements will change. We're going to discuss a little bit more about the changes in EPC rating. And then, of course, as we go through these two stages, we're gonna need some strategic alignment between landlords and tenants, which will be key for this change. And finally, which I believe is the most important factor, is credit risk and green finance. So reputation and improved long-term return will steer the market towards sustainability, whether or not it's a large unit or an industrial estate, which actually leads us nicely to our final slide. So I've done a little bit of research and found this survey run by the S&P 500, so Global Markets Intelligence, looking at motivators for considering ECG with regards to financial institution, banks, money manager. And the first thing that popped up was actually improve long-term returns. And then, of course, brand image. So what is driving this change? Of course, is climate change and regulation, but main two things are consumers and suppliers demand, and then, of course, long-term returns. So on this note, I'd like to hand you back to Jessica for our panel discussion. Thank you very much. We might have encountered a little technical problem here. Let me just check if Jessica is still connected. Okay, so Jessica might have a little technical problem here. So what I would suggest, just to start our discussion, Bruce, if I may ask you the first question, given how busy GLP have been, particularly with your scheme in Lutterworth. Is there anything you want to share on that front that be of interest of our audience? Because I know you've been raising the bar each time with every new scheme that you've been bringing forward onto the market.
Thanks, Andrea. Yeah, and good afternoon, everyone. Yeah, I think just maybe on a general sort of note, in terms of if you look at the construction industry globally, and we're part of that, obviously, you know, that accounts for about 40% of global carbon emissions. So in terms of when you're talking about ESG, one of the key factors is to reduce carbon. And, you know, as developers, we obviously have a responsibility for that, to do that. And to sort of seek continuous improvement on that line. One of the aspects we've been able to do that is in the slabs, in the concrete, we've used a substance called GGBS, and that's basically power station ash, and that reduces the cement content, so that reduces the carbon footprint of the slab. We do that in all our buildings. Other aspects could be intelligent lighting, building environmental analytics, which we put into offices. So when customers take our buildings, they can choose to extend that into the warehouse area for their fit out. So that gives a sort of smart building. They can analyze where the warehouse is being operational effectively or more efficiently in other areas, etc. So it gives them knowledge and data to use to improve their operations, which reduces their operational costs and the energy they use. I think also in terms of the social value side of things, when we're looking at local communities, improving that aspect, and that's not just country parks and footpaths, but it could be outside gyms as well. And you know, at Lutterworth, you say, but also at Magpie Park, Milton Keynes, we've got hives. We've got 1 million bees making honey, and we also made hand sanitizer in the pandemic as well. So as part of that, we in the dementia centre we've sponsored at Lutterworth, that the hand sanitizer went to that centre as well, for example. So that's part of social and the community engagement. And you know, the other part of ESG is the governance part of it, and it's important to ensure that is a top-down, bottom-up approach. So it's linked throughout the organisation, and the colleagues and employees have training and seminars on the different aspects of ESG, which we do. So to your point about Lutterworth particularly, but I think on all our developments, we've aligned with Planet Mark as well, and that sort of helps help us measure our carbon footprint and sort of bring down the carbon in all our buildings. And we're probably about 25% saving on carbon at the moment across the board. We started doing it last year, so I think one of the points to be open about is that we're all learning as we go, frankly, as a business, as a sector, as an industry. And we've shared information with Kevin and other customers as well. And I think that's another important point about continuous improvement. So thanks, Andrea. Jessica's back. Hi, Jessica.
Well, that's typical, isn't it? At least you guys know that this clearly is live. I hope it doesn't do that every time I ask people a question. Don't worry, it won't. Moving on then, and thank you so much for that, Bruce. Thank you so much for stepping in as well. So Kevin of DHL, so you have part of your organization to decarbonize. So what does sustainability mean to DHL, and how are you moving forward? What are your goals?
Well, DHL has set out that they're going to be carbon neutral by 2050, and that's a really big task for our industry, and that covers the whole business. The big challenge for us is we now are setting ourselves a target of having carbon neutral or net zero carbon warehouses by 2025. And that's a big challenge for us, because we've obviously got, by implementing a renewable energy hierarchy in conjunction with energy consumption reduction, the ideal aim is to reduce CO2 and emissions to net zero as soon and quickly as possible. What we can't do is possibly in certain cases completely do that, so we'll obviously be doing some sort of offsetting. But that means for us in our sector that we've got to look at the design of buildings. Bruce touched on obviously efficient lighting, intelligent high frequency charging, using green energy, electricity is going forward, and all sorts of technology, warehouse management systems, heat ground source pumps, biogas, reflecting coating on buildings. We're looking at everything to try and mitigate the amount of energy we actually use in the building, as well as on top of that with regard to going forward, the operation internally becoming more and more sophisticated with technology inside the warehouse. So from our point of view, it's very much a forefront of our strategy. It's a challenge because we think that we're still behind the pace, and we need to do a lot more, and I think the industry needs to do a lot more. But the customers are demanding it. We just saw Andrea show what is high on the priority with companies with ESG. They're seen as a benefit to businesses because it drives innovation, and it ensures that people buy our product, and our customers demand, especially on the 3PL side, our customers are coming forward and saying, what are you doing? Because we are selling ourselves to the public, and we have green credentials, so it washes its way right through the system.
And interesting you say that point, you're very much responding to your customers' demands, but, Kevin, how much do you see, landlords really responding to the fact that clearly sustainability, your net zero carbon targets are clearly very important to you?
I think the challenge is that there is a recognition. I think the problem is that a lot more people have to get on board with it and understand that that's going to be a demand from occupiers, and it will be a differentiator between, in future, possibly what buildings we take and what buildings we don't take, purely because within our organisation we now have criteria that says when we're doing a project, what is the Go Green credentials, and that's not just on the warehouses, the transport, it's the whole package. But that's been asked before we actually take a project forward, and that will be a selling proposition to our customers as well, as a differentiator. So we want to work with landlords and get them to now have almost outstanding buildings. And that's our goal, is to get our buildings to that quality of portfolio in our network. And if the landlords won't do it, we then have to possibly, not so much in the UK yet, but in Europe, we're just buying the sites and doing it ourselves, because we have to, because we've set ourselves those agendas. And that's a corporate policy which we're telling people. So, you know, it's something that's not going to go away. And so therefore, my view is that it's going to be even more important, because as Andrea pointed out, I think legislation is going to force us down that route as well, in a number of various areas. So it'll be interesting to see how the industry captures that. I think Bruce has obviously shown that the way and several other the big players are doing that, but it's what you do with your buildings once they've been 20 years old and they don't have, example, good airtightness, they don't have the decent doors, and all that is extra cost, and we don't want cost. We're trying to get cost out.
Yeah, absolutely. We can pick up a little bit more about what do we do with non-sustainable stock a little bit further on in the conversation, but a good time to bring you in, Andres. I mean, you know, Kevin and Bruce, obviously clearly organizations working really hard at this, but I mean, do we in the industrial and logistics sector even have the right metrics in place to help people or guide people who want to know a little bit more in terms of benchmarking sustainability? You know, there's BREEAM, we talked about EPC ratings. Do we need more? And is what we have fit for purpose?
Yeah, that's a good question. I mean, we do like a good stamp on a building to make the process a lot easier, but the reality is that when we talk about you know, things like net zero, for example, I think we need to acknowledge that it is a rather complex you know, topic, and I tell you why. I think Bruce made a really good point in terms of that approach you know, to net zero emissions, and they are looking at the whole life model of the building. And I think, you know, for the industrial sector in particular, that's really key, because the embodied carbons that is the carbon related to materials, construction, disposal, and refurbishment for a typical warehouse is more than, or is around, you know, 50% of the total life cycle emissions of that property. So, you know, to get that right in the first place is very important. And I think metrics and legislation is definitely going to move you know, towards specifying a percentage in terms of carbon, embodied carbon reductions that you're going to have to achieve down the line. And I think it's important, you know, to make that distinction between the emissions that happens during construction and the emissions that happens during the operational phase of the asset. So it's all well and good, you know, to put solar panels and lighting controls and very efficient you know, lighting fittings, but if from the start, you know, the building is not thought, you know, to be net zero during the construction phase, then we're probably missing you know, a trick. So I think, you know, unfortunately, we don't have a BREEAM stamp that you know, that says your building is net zero. That's probably going to you know, come up in the next few months. Apparently, the ISO standards are gonna bring something, you know, to the market, you know, for net zero, and that might be something that the industry can use, you know, from a marketing, you know, perspective. But I think it will also drive you know, this type of facilities, because if you're an occupier and you know, if you're someone like DHL that want their real estate, you know, to reflect their corporate ESG drives, I think it's not as easy, you know, to really find a net zero building out there in the market. So definitely that you know, transparency and those tools, those industry tools, would make it a lot easier.
Thank you. That sounds like a good moment to bring in our polling question number 1 to the audience. which is about your view on, do you think the industrial and logistics sector should get its own sustainability assessment method that is specific to that? So if we could get that up for you guys to answer, that would be great. And while the audience is having a few minutes to answer that, it'd be good to get your thoughts on that. Bruce, do you feel that you need a little bit more specific guidance? It's interesting the point that Andrea said about it being hard to find in the market about the buildings that are net zero.
Yeah, it is a really good point, and you touched on BREEAM. You touched on, well, we haven't touched on BREEAM in use. That's another measure. That's as the asset is in use and stabilised. There's obviously Planet Mark we mentioned about before. There's also GRESB in terms of as an investor developer. That's a very important measure for us in terms of data, collating data, and there's a challenge on that for all of us. But and that GRESB covers all of ESG. In terms of what I say about BREEAM and all our buildings are BREEAM excellent, but in terms of that BREEAM measure, that's a one moment in time and when it's PC, practically completed. So it doesn't go on beyond that, and that's sort of where the BREEAM in use comes in. But I think there probably should be better guidance in terms of a measure for the industry in that respect. But I think BREEAM would need to change, have it be sort of an updated yearly like GRESB does. So I don't know if Kevin has any thoughts on that, or Len as well. But another point I'd just like to mention, because you talked about legislation earlier as well, and that is going to be a factor in our sector and our industry. I mean, just speaking on one point in terms of biodiversity net gain, that'll be legislation later this year. So if you're looking at development, which is more, spans across a few years probably, we're looking at that now, and have done in the past, of course, but more specifically now, and it's not going to go away. And local authorities are bringing that in advance of legislation when it filters down eventually. And that may be 10% by net gain or 5%, but it's material, and it's something I think maybe, as I said before, we're all sort of on a pathway learning about this as we go through it, and it's an important factor to take on board right at the outset of when looking at a project.
Can we just get back the results of the poll, and then I'll come to Kevin and also get your thoughts, Len, I think. So yes, you think we should. Interesting. Well, actually, I'm going to give Len the opportunity to respond in the sense of it's interesting this. I don't necessarily would have thought that you guys would have said you wanted your own industrial and logistics sustainability assessment method. I mean, Len, what are your thoughts in terms of the positives and the negatives of this? Is it a chance to the sector really to move itself forward, or could it be a rod for it to beat itself with?
I actually think it'd be a really good thing to actually try and move the sector forward where it's a sort of standard sort of acid test, really. I know a lot of the developers such as GLP and others are obviously trying to move it forward and doing a good job of that with the occupiers in tow, but I actually think it would be a good thing. Obviously, it's very subjective, Jessica, and some wouldn't, but I think it would be a useful thing for the industry to have something like that. Yeah.
Yeah, thank you, everyone. Interesting point there. And yeah, Kevin, kind of to you, I think it's really great to have an occupier on the panel because you really do experience the real practical end of this. But I mean, would it be useful for you to have that filter to show these kind of buildings, and then also leading on to that, is that already, and could we see a market of two halves in which, there's a widening gap between the sustainable properties and the non-sustainable properties? And could there be a benefit for you if you start seeing a little bit of rent reduction for that?
The critical factor is we're always being forced to drive down costs in the business. And that comes from trying to take more technology to improve that. And we're in a place where, the energy data, smart meters, etc., just one of the examples where we're always looking at how do we get cost out of the business, and that comes through the whole process of evaluation. And we're always evaluating new technology, like LEDs came through. We didn't jump on straight away. We evaluated over a number of years, did some testing before we eventually said, yes, LEDs are in a place where they start really making an impact and a difference. And again, with photovoltaics, again, you know, people suddenly say, oh, put photovoltaics. Well, you look at payback periods, etc., how good they are over a period of time, you do testing. So all this is all about cost and how we get cost out of that. And that is going to becoming more and more prevalent in buildings. And clearly from our point of view, I believe that that's got to carry on. Bruce obviously mentioned that, you know, you're evaluating the life of the building as well. And it's all about the life of the building, the cost that's going to run through that. And if we have an old building, if it's not giving us what we want and we're having high running costs, then we're just disregarding it. And it will become more and more prevalent. You touched on, is there going to be two different types of models? And I think there will be, and I think you'll find that certain occupiers will only go for certain type of product. It'll be because that's in their DNA, and it'll be because they're looking at the life of the building, the life cost of the building. And also that comes with that will be the social impact with regarding recruiting people. You got a nice building, it's always good for people to go to a nice fresh environment and all the things that go with that, compared to an older property, which probably is not quite so attractive and is costing you just as much money and probably is not really value for money. So it'll be interesting to see how that plays out. I think the challenge for us is, as an industry, is to understand that what our customers wanting and going forward with that. And there is definitely a move, especially in certain sectors, and it will come through everywhere, that you have to have the ability to show that you're doing your bit for society, for the environment, and that will just push everyone towards the view of the buildings have got to improve, and older stock will have to reinvent itself. So is there going to be a two-tier market? I think there will be. Where will we be playing? Well, you know, we will be looking for quality buildings. And as I say, we've got a remit going forward of what we're stating we're looking for. And that will start discounting. And agents will be phoning up saying, I've got this building. We'll say, well, we know the building, it's just not there for us. So what are we going to do about it?
Yeah, interesting point. Andrea's kind of bringing you in on that. What are we going to do about it? You know, obviously, as Kevin said, there might be many outmoded buildings in portfolios, but you touched on, you know, the inherent carbon in these buildings. And, you know, there could be an argument in some cases about whether wholesale demolition and then rebuild is right. But then, you know, given some of the changing occupier needs, how much can, you know, an obsolete shed be made to be fit for the future?
Yeah, exactly. I think that's the assessment that we're going to have to do when it comes to that decision. And we've got the tools, you know, to help us understand, you know, from a whole life perspective, whether knocking the building down and starting from scratch will be the preferred alternative from a carbon you know, budget perspective or not. But I think there's another point that I think will make you know, those two tiers a lot more explicit, and is the existing, you know, requirements with regards to the EPC rating. So, you know, we currently have a requirement you know, to have a minimum EPC of band E before leases can be legally granted and renewed. And we know that that's going to be raised to band B by 2030. That's going to mean a significant amount of work, you know, to get to that point. And the critical issue would be, you know, to understand that whatever interventions are being done now, you know, today, are probably going to be affecting how that property reaches or not, you know, that minimum rating in the future. And if we look at what's happening a little bit in other sectors, offices, for example, you're starting to see landlords becoming quite aware of that requirement and that challenge, and for example, requiring the occupiers, to model the impact that their fit outs are going to have on that EPC rating of the building by using the landlord's EPC contractor or the EPC model that has already been established. So I think we have the tools. It is a real it is a real challenge. But if we are serious about achieving net zero, that's the only way, because the alternative, to not achieving net zero is probably a lot worse.
And while we're on that point about the kind of segregation of the market, let's talk about money. I think Andrea, you touched on this a bit in your presentation, but changing sustainability levels and the future of a building, that's going to impact values of portfolios as a whole, but also presumably, investors, the kind of developers and the kind of schemes they put money into. I mean, Bruce, have you seen that in terms of that shifting appetite, that kind of more critical view of the investors that you guys might be working with to bring forward?
Thanks, Jessica. I think undoubtedly sustainability is, as Kevin has said, important to their customers, important to 3PLs, so it's important to our customers, and it's most definitely important to our investors and us as a business. So I think from a customer point of view, it's almost where, and also from a developer's point of view, you can't afford not to do it in our buildings. And Andrea's picked up a really good point in terms of, the first opportunity is when you're building the building, and there's sunk carbon into that building, it's there for the lifespan of that building. So then you need to look at how you improve the development part of it first, and then the efficiency of the building when it's in use, and then you sort of, when you deconstruct it as well. So you're looking at the whole life cycle of the building, which is what Andreas is pointing to. And if you can look at it in that respect, you sort of get the feeling and understanding that you're doing the right thing, and but also there's inherent good investment, and we're an investor developer, and we're looking to invest money in the right way.
Thank you. A question from the audience for you, Kevin. Now, we touched on, do you think you should pay less if a building isn't sustainable enough? But would you, be willing to pay a higher rent for more sustainable properties, even though, you touched on obviously it being important to cut costs, not too ruthlessly, but you've got to keep an eye on your expenses. And then within that, would you pay higher rent for more sustainable properties? And is on-site rail freight worth paying a high rent for?
Right. The question mark is, what is the standard we're now expecting? And, everyone starts saying, well, you put more in, you have to pay for more. But the challenge I've got is that it all comes down to a value proposition. And if a building will save us money because of the technology and the investment that's been put in, then it's logical for us to do that, because at the end of the day, we're looking to get our carbon footprint down. And as long as it doesn't cost us money, then we'll do it. It doesn't necessarily always have to be that we have to make money. But the point is that, if over a payback period, it's reasonable, we will do it. And if the landlords won't do it, then we'll have to look at it ourselves, because we have given an undertaking to get our carbon footprint down. And that means investment in technology, etc. So it's not a straightforward question. The point is it's all about the proposal, and the proposal being economically viable. So we will not put a wind, example, someone say, oh, put a wind turbine up. If we're only in the building for 10 years and the payback's 20 years, we're not going to do it. It may be the right thing to do, but then we would say to the landlord, well, you invest it, you want to get your carbon footprint down, we'll pay a proportion of that cost over the period of time. So the next person gets the benefit as well. So it's all about logical investment and clever investment and using the money wisely. So it's not just, oh well, we're just going to charge you more money for that. We've got to see some real benefit in some respects with it's not going to cost us money, but at the same time, we are going to win from it as well.
Does that also mean that on-site rail freight isn't necessarily worth paying a higher rent for unless over a long period of time you actually see the benefit to your business?
Rail freight is a very, very topical subject because we don't put enough stuff on rail, and there's a number of reasons why that you could go into war and peace on. The challenge we've got is that it's a very big investment and it needs commitment from government to make it really work. That's my view in some respects. I think it's a good idea, and certain products definitely benefit from being put on rail. An awful lot of products don't, and the speed of movement is now becoming more challenging. And as everyone knows, we're going into last mile, and it's quickness of delivery. So rail has its uses, but is it the solution in this country? Probably not. I have a view on that because certain countries are far bigger, so they have far greater distances, and so therefore it's more economic to do that. The UK is quite a small place relatively, and where the conurbations are, especially, transport still is probably the better solution, more efficient solution, especially with the view that as technology in the transport network improves, we're getting more and more of vehicles that are going to be electric, and I think it won't be far before there's more of that coming down the line with the larger vehicles. So that's the challenge really. So do we pay for it? I haven't seen anyone saying they want to, and I haven't heard any of my colleagues saying they want to, so probably not.
Great, interesting. Thank you, Kevin. And interesting that you touch on those energy requirements there. Before this event, quite a few of you in the audience did put forward questions or points about, these sites obviously very energy hungry. So in terms of how are you assessing the utilities that are coming into the site beforehand, potentially, before development and acquisition, and, how much work is being done to ensure renewable energy and other energy sources are available in the coming years? I mean, Andres, would you like to comment on that?
Yeah, sure. Yeah, I mean, due diligence is part of what we do to support the pre-acquisition process. I think obviously the EPC has become again a very important investment parameter. Just to shed a bit of light, if your building is of a certain age, what we've seen working in a practical way to improve the EPC is roof insulation. That seems to be a fabric measure that is cost effective and also has an impact on the EPC. So it's a bit of a win-win situation. But going forward is really difficult to assess what the operational performance of that building is going to be. So right now, if you're a prospect tenant looking for space, and this is not particular to the industrial sector, to get an idea of what's the operational efficiency of an asset is really difficult. And in fact, the government is consulting right now to introduce an operational rating that will provide visibility to both prospects, buyers, and tenants. So, but I mean, but obviously you can realize if there's old kit in the building that is likely to be changed, that needs to be assessed both in the context of what, from a compliance point of view, what is it going to do to the EPC, and what costs are going to be likely to be involved to replace that bit of kit, because obviously that might be something that is going to be passed down to you over the long term. But also you want to see what's the controlling equipment. So in warehouses, for example, the amount of daylight that you can maximize means nothing if you don't have daylight sensors, for your light fittings inside. So I think it's a combination of like what can be practically achievable versus that EPC minimum that you're gonna have to meet at the same time in the long term.
Thank you. Can I get the second poll question, please, about the moving out of yields on non-sustainable buildings, or non-sustainable yields, as I accidentally called them, before this event? So when will we start to see yields on non-sustainable stock moving out? And as the audience ponders this, Len, it'd be interesting to get your view on it. I mean, as with most things, counter-cyclical opportunities, if buildings start to get a little bit more affordable, do you think that'll help in terms of, opportunistic purchases coming in, more stock they can buy to spruce up?
Thanks, Jessica. I think that will have an impact on price. And I think the question is a good one because it comes down to timing. I think my personal view is at some stage that it will have an impact and the pricing will move out. I think when that actually happens, that is a tricky question. But if you were to ask me and put it, I'd say 4 to 6 years, Jessica. And I think, it will have an impact on some older accommodation if substantial works need to be done to bring it up to a certain level from a sustainable perspective.
Let's see the poll response then. Yeah, 4 to 5 years to 6 years. I think you're pretty close there, Len. Yeah, so not something that's going to happen super imminently, but certainly something that's probably going to start biting in the next few years. Question again from the audience for Andres. So to maintain EPC-B from 2030, will the responsibility rest with the tenant to mitigate their impact, i.e. to reinstate minimum EPC-A on vacation? Hopefully I read that right and it makes sense to you.
Right, okay. So, the first thing to clarify is that the MIS regulations, so the minimum energy efficiency standards that require that minimum EPC rating, so the requirement is for the landlord. So the requirement is for the landlord not to grant or renew a lease of a building that has an EPC of a certain rating. So in 2030, we don't know exactly how the implementation of that minimum rating is going to be. So if we look at what's happening now, so from April 2018, is illegal to let a space that has an EPC of a F or G, and that requirement will extend to all existing leases from April 2023. So if the government decided to implement that stepped approach with a soft and a hard start, then it would be the landlord who will be in breach of the regulations. And I think going forward, this is more of a personal view, what is likely to happen when we get to 2030 and there's a requirement to meet that minimum band of B. I think you're going to find that there's probably not that much that you can do to your building. So the focus is going to be again, on the operational side. So what kilowatt hour per square meter ratio are you running your building? So if again, if we're thinking about a net zero strategy, once the building is built, then the focus should be in reducing those operational emissions. And I think by the time most properties are lifted to a certain EPC rating, the focus needs to be on the operational side.
Great, thank you. And just, a quick look at another sector, because I know Andres and Andrea, you've done a little bit of work in terms of looking to the office sector in terms of, learnings from that. If you'd like to just give a very quick overview as we come into the last 6 minutes of the webinar.
Yes, Jessica. Yeah, thank you very much. So because of course our sector is quite particular, so the industrial sector. So we wanted to look to see what happened in the office sector, to be honest, because it seems that there has been a little bit more advancements in that front. And what we actually looked at, whether or not there was a relationship between prime yields or yields and the EPC rating, or whether or not this might have actually put off certain investors to purchase a certain building. Unfortunately, we haven't been able to find any hard evidence because, of course, of the lack of comparables. But I've been speaking with my office colleagues and my other colleagues in research. So but this is more of an impact, an accidental impact, because let's say you look at central London or you look at other major markets in the UK. So prime yields and prime demand is usually for those buildings who are quite sustainable. So, and most of those investors, particularly Asian investors, are always looking for a shiny building and also for a core or value add development opportunity or investment opportunity. Hence why there is not really any hard evidence, mathematical evidence to justify that. But of course, the office sector is completely different than our sector. Certain buildings, if of course purchased on a certain time, can be redeveloped potentially into residential, or given that your office building is an urban center, can be of course sold to a different use, potentially a hotel. So it's completely different from our sector. So my personal view is that we shouldn't really be looking much at what happened in the office sector, what's happening at the moment in the office sector, but we should really focusing in details in our sector. So for instance, I'll give you an example. So let's say we have a distribution warehouses in the middle of close to motorways. There's not much else you can do with that park or that warehouse. You can't really build a residential building on a hotel or a shopping center. Hence why we should be mindful and focus 100% and act as soon as possible, where possible, trying to future-proof our investment.
Wonderful, thank you. And that leads me on very nicely to my final question that I'd like to ask all panelists. I'll go from left from what I can see, so I'll call your name out. But yeah, future-proofing, I think is kind of the name of the game here, but I think also is quite a conundrum. Obviously, because we don't know what the future is going to look like, autonomous vehicles, charging points, like what that level of warehouse usage will require. But if you had to look into your crystal ball, 10 years time, Bruce, what is the one non-negotiable thing you think that warehouses will need to factor in when it comes to this kind of sustainability agenda?
That's one thing. There's must be quite a few things, but I think ultimately natural power, so PVs on roofs, and that speaks to Kevin's point about long-term investment in the building. If the lease is 10 years and the payback is longer than that, that's for the landlord to do, and that makes sense. And from an investor point of view, long-term investment for in the right building for the long term. And I think also the you get the right building, customers want to be in that building quicker and probably stay in that building longer. So the economics make sense. But to answer your question, probably PVs on roofs throughout, really.
Thank you. And now no one else can say that. No echoing, please. Kevin.
Sorry about that. Bruce stole my thunder. I think the critical factor is power. The reason why is any building that's going to be last mile is going to be in very urban areas, and they need the power to. All the vehicles are going to be electric. We've even got our own manufacturing plant in Germany building vans. They're electric vans. We've got 5,000 already there, and there's going to be a complete rollout eventually of our network of electric when possible, as a matter of course. That obviously is going to put demand on power. Some of it will be able to come from PVs, etc. There'll be other elements of obviously smart metering, so the vehicles can be actually charged at the right time of night, etc., when the costs are low and the demand is low. But power is going to be very, very important for me. And I think it's just going to be a game changer. And I think it'll be, if we don't do it, it'll be legislation will come in. And I think we all are recognizing that big cities are bringing in more and more conditionality about the type of vehicles, which means that as a business, we have to get to our customers and deliver to our customers. And therefore, in that respect, you know, we're going through the whole gambit of the street scooters, which is our vans, and we have people who are on bikes. We've even got now a boat going down the Thames to get into locations without having to use diesel, etc. So from our point of view, I think for me, it's power and electric, and the game changer is in conurbations especially, you know, there will be a need to have that power there.
Wonderful, thank you, Len.
Thanks, Jessica. I am going to cheat because Kevin said one of them, so is Bruce, but I think it's people. So in locations where you've got good demographics for a work profile of employment pools, I think it's very, very important. Everyone is talking about technology and robotics, but I think they have to upscale on the people. So people and power, which all sort of takes Bruce's and Kevin's. So apologies, Kevin and Bruce.
Wonderful, power and people. Andrea?
Okay, so Len now took mine, so I'm gonna have to go back and really emphasize you know, power, but I just want to kind of almost, you know, make a challenge, because I think that the industrial and logistics sector can be, you know, the champions for solar. I mean, you know, long leases coupled with roof space. I mean, you know, maybe solar and rain harvesting systems. But you know, we've got the roofs, and that's something that needs to be considered also, you know, from the development point. That's something that in no other sector apart from maybe, you know, shopping centers you're going to find. So there's a great opportunity, you know, right there to increase our renewable capacity, maybe mixing it with load management and battery storage systems, which are going to be, I think, an essential part of the mix.
Thank you. And Andrea, give us the last word if they haven't already mopped up all of your potential predictions for what a warehouse in 10 years' time could need.
Okay, this is very unfair, Jessica. I'm the last one, so there is not much more left, and we're also running out of time. But anyway, I think, yeah, it's just gonna be, I'm gonna have to repeat, and it's gonna be power, renewable resources. Thankfully, hopefully, the government is actually making some big headway, big investments into that in the north of England, also in Scotland as well. The agenda seems to be fairly good, particularly when you compare to other European countries. So I'm hopeful that in 5-10 years time, the UK will actually be running, the majority of power would be from renewable resources. 5 years time is a very ambitious goal, but 15 years time we could get there.
Brilliant. Thank you very much, everyone. Thank you to our wonderful panelists, to our guest panelists, Bruce and Kevin, and of course, the wonderful guys from Colliers, Len, Andrea, and Andres. Thank you very much, everyone, for tuning in, and please enjoy the rest of your afternoon.